While the retail market focused on volatile technology stocks, institutional capital quietly staged its most aggressive bond market accumulation in years. Back-to-back soft inflation readings have completely changed the macroeconomic narrative. This cooling data suggests that the aggressive Federal Reserve hiking cycle has finally reached its terminal peak. Smart money is rapidly pivoting from high-yield cash proxies into long-duration sovereign debt. The immediate question is no longer when the next hike occurs, but how fast yields will fall. But that is only part of the story. To understand this macro shift, we must look at the structural foundation of the bond market. United States Treasuries represent the ultimate collateral for the global financial architecture. When yields peak, the valuation framework for every corporate asset class shifts. The iShares 20+ year Treasury Bond ETF, ticker TLT, serves as the primary liquidity vehicle for this space. As yields decline, the capital appreciation potential of these long-duration assets starts to dwarf short-term money market returns. Here is where the business mechanics of this migration become highly profitable. BlackRock, ticker BLK, stands as the gatekeeper of this structural capital rotation. As the largest asset manager in the world, BlackRock controls the primary pipelines for institutional fixed income products. Their proprietary technology platform manages trillions in global debt assets. This scale gives them an unmatched structural moat during massive portfolio rebalancing phases. When systemic capital rotates from cash to bonds, BlackRock captures a massive share of the underlying inflows. That transition leads us directly to the quarterly performance metrics. Recent financial statements from BlackRock highlight how resilient their fee structures are. Even during periods of high-rate volatility, institutional mandate wins kept assets under management stable. Now, as bond prices recover, BlackRock is experiencing a multi-billion-dollar surge in net new assets. This trend is highly positive for their operating margins. Fixed income exchange-traded products generate highly predictable, recurring fee streams with minimal incremental operating costs. Now look at how the broader indexing sector is reacting. The Vanguard Total Bond Market ETF, ticker BND, has seen a dramatic volume expansion. This broad-spectrum fund tracks the entire investment-grade bond universe. When systemic risk fades, capital flows steadily into these core indexing vehicles. For retail and institutional allocators alike, the relative safety of a diversified bond basket is now highly appealing. This broad-based recovery indicates that fixed-income products are reclaiming their traditional role as portfolio shock absorbers. The next signal comes from management's capital allocation outlook. During recent investor presentations, top executives at BlackRock emphasized a generational buying opportunity in fixed income. They highlighted that institutional cash balances are at record highs. These funds must eventually be deployed to match long-term pension liabilities. With inflation showing clear signs of cooling down, management is actively advising clients to lock in elevated yields. This corporate strategic push is designed to maximize their asset gathering before rates decline further. But asset gathering is only half the battle. Large institutional mandates require complex risk management infrastructure. BlackRock's proprietary risk system, known as Aladdin, has become the industry standard for these large allocators. By integrating portfolio construction with macro forecasting, they provide unique value to sovereign wealth funds. This technological moat ensures that institutional capital remains locked into the BlackRock ecosystem. This sticky client base provides strong defense against competitors trying to capture the incoming fixed income wave. This shift brings us to the macroeconomic landscape. The back-to-back consumer price index reports show that structural pricing pressures are easing. Supply chains have fully normalized, and wage growth is steadily moderating. For the bond market, this data is the ultimate green light. Long-term bonds are highly sensitive to inflation expectations because rising prices erode fixed interest payments. With inflation cooling down, the real yield of these bonds becomes significantly more attractive to global capital. That leads us to a bigger question regarding central bank policy. The market is aggressively repricing the path of the Federal Reserve. Previously, investors feared a high for longer interest rate regime. Now, swap markets are pricing in multiple rate cuts over the next 12 months. This sudden policy pivot creates a highly favorable backdrop for sovereign bonds. Historically, the early stages of a rate-cutting cycle yield the strongest performance for long-duration fixed-income assets. However, we must address the significant structural headwinds. The primary risk to this bond rally is the persistent United States fiscal deficit. The government is issuing debt at an unprecedented pace to fund public expenditures. This massive supply of Treasury bills and notes could overwhelm market demand. If institutional buyers demand a higher premium to absorb this supply, bond yields could remain elevated despite falling inflation. This fiscal dynamic remains the most critical systemic risk to watch. The second key risk is the potential for inflation to remain structurally sticky. Geopolitical tensions, trade protectionism, and commodity price spikes could easily reverse the progress on inflation. If inflation rebounds, central banks will be forced to keep interest rates higher for longer. In this scenario, long-term bonds like the iShares TLT would experience renewed downward price pressure. Portfolio managers must balance their bullish duration outlook against these persistent, unpredictable global inflation catalysts. Despite these risks, the long-term outlook for fixed-income assets remains highly compelling. Yields are currently consolidating at historically attractive levels, offering strong income protection. We are placing long-duration treasuries on a breakout watch. As inflation continues its descent, these assets offer a unique asymmetric risk-to-reward profile. The capital appreciation potential during a rate-cutting cycle provides a powerful hedge for broader equity market downside. This structural setup is highly favorable for long-term investors. That dynamic leads to our multi-year thesis on institutional asset managers. BlackRock is positioned to benefit from a long-term capital migration. As capital leaves high-cost retail savings accounts, it will flow into institutional managed solutions. This structural trend will drive sustained fee growth for BlackRock's diversified product suite. Their scale, technological integration, and product variety make them the primary winner of this transition. The company remains a high-conviction exposure for those seeking institutional-grade compounders. In summary, we suggest a detailed tactical review of current asset allocations. We maintain a breakout watch on the long-duration Treasury ETF, TLT, as it continues to form a base. Concurrently, we suggest a trim consideration for short-duration cash instruments that no longer offer optimal yield protection. Transitioning some cash to long-duration bonds represents a strategic move to lock in yield stability. This rotation ensures that your portfolio remains insulated as monetary policy shifts. This structural macro shift is just beginning to play out across global markets. As institutional desks adjust their positions, we will continue tracking these flows closely. To stay ahead of these complex macroeconomic shifts and institutional asset movements, subscribe to SR Money News. We deliver deep institutional research and asset management insights directly to your screen. Join us as we navigate this changing financial landscape. Thank you for watching, and we will see you in the next analysis.